Standard credit card. A standard credit card is the most basic and traditional form of credit card. It allows you to borrow money from a bank up to a set limit and pay it back later. If you pay the full balance by the due date, you usually avoid interest. If you carry a balance, interest is added. These cards became widely popular in the second half of the 20th century as banks expanded consumer lending. What makes them different is their simplicity. They focus on providing access to credit without complex reward systems. They matter because they form the foundation of how modern consumer credit works. Rewards credit card. A rewards credit card works like a standard card, but gives something back for every purchase. That reward might be points, miles, or cashback. The concept grew as banks competed for customers and looked for ways to encourage more spending. Instead of just borrowing, cardholders feel they are earning something in return. The value often depends on how much you spend and how you redeem the rewards. These cards matter because they turn everyday expenses into measurable benefits. Cashback credit card. A cashback credit card gives a percentage of your spending back as cash. Sometimes it is a flat rate on everything. Other times it offers higher percentages in certain categories like groceries or fuel. Cashback cards became popular for their simplicity and transparency. You do not need to learn complex reward systems. What makes them different is that the reward is direct and easy to understand. They matter because they provide predictable value for people who pay their balance in full each month. Travel credit card. A travel credit card is designed for people who spend money on flights, hotels, and international purchases. Instead of simple cashback, it often provides airline miles or hotel points. Some offer benefits like travel insurance, airport lounge access, or no foreign transaction fees. These cards became more common as global travel expanded and partnerships formed between banks and airlines. They matter because they can reduce the cost of travel significantly. However, they usually require higher spending to unlock the best benefits. Secured credit card. A secured credit card requires a cash deposit before you can use it. The deposit usually becomes your credit limit. It was created to help people with no credit history or damaged credit rebuild trust with lenders. Because the bank holds your deposit, the risk is lower. What makes it different is that it functions like a normal credit card while being backed by your own money. It matters because it provides a structured way to build or repair credit over time. Student credit card. A student credit card is aimed at young adults who are just starting to build financial independence. Approval requirements are often more flexible. Credit limits are usually lower. These cards appeared as banks recognized the long-term value of building relationships with students early. They may include simple rewards and educational tools. They matter because they introduce responsible credit use at an early stage. Over time, that shapes future financial habits. Business credit card. A business credit card is designed for business expenses rather than personal spending. It helps separate company purchases from personal finances. Many offer rewards tailored to business needs, such as office supplies or advertising. These cards developed as small businesses and entrepreneurs needed flexible financing tools. What makes them different is that approval may depend on business revenue as well as personal credit. They matter because they simplify accounting and provide short-term funding for operational costs. Balance transfer credit card. A balance transfer credit card allows you to move existing credit card debt onto a new card. Often it comes with a low or 0% introductory interest rate. This idea grew as lenders competed to attract customers carrying high interest balances. For a limited time, interest charges are reduced or paused. That gives borrowers space to pay down debt faster. They matter because they can lower the cost of repayment when used carefully. Low-interest credit card. A low-interest credit card focuses on offering a lower ongoing interest rate instead of rewards. These cards are designed for people who sometimes carry a balance from month to month. Historically, they appealed to more conservative borrowers who valued predictable costs over perks. What makes them different is their emphasis on minimizing interest charges. They matter because they reduce the long-term cost of borrowing when full repayment each month is not possible. Charge card. A charge card looks similar to a credit card but works differently. It requires the full balance to be paid each month. There is no option to carry debt. Traditionally, there was no preset spending limit. Charge cards became well known through premium issuers that targeted higher income customers. They matter because they encourage disciplined spending. At the same time, they demand strict repayment on time. Store credit card. A store credit card is issued by a specific retailer. It can usually only be used within that brand or group of stores. Retailers introduce them to encourage customer loyalty and repeat purchases. Approval standards may be more flexible. However, interest rates are often higher. What makes them different is their limited usability and frequent in-store discounts. They matter because they can provide short-term savings for loyal customers. Prepaid card. A prepaid card is loaded with your own money before you spend it. Unlike a credit card, there is no borrowing involved. These cards became common as an alternative for people who want card convenience without debt risk. You can only spend what has already been added to the card. They matter because they offer budgeting control and accessibility. However, they do not build credit history.